Welcome to Iron Financial. We're the only place on the web dedicated to stress testing the market's biggest stories so you can forge a stronger, more durable portfolio. I'm your lead analyst. Today, we are cracking open the medical device giant Stryker. They just reported a Q4 that absolutely blew the doors off expectations, and the bulls are in a frenzy. But here at Iron Financial, we don't chase hype. We inspect the foundation. We check the load-bearing walls. Our job is to figure out if Stryker is a financial fortress built of solid steel or if it's just a house of cards waiting for a gust of wind. Let's get to work. Whoa, let's pump the brakes for a second. An 11.4% revenue surge? Yeah, that looks fantastic in a headline, but you and I both know headlines are cheap. I'm your market skeptic, and it's my job to ask the tough questions, the ones that cheerleaders on Wall Street don't want to answer. Are we really looking at a company firing on all cylinders, or did they just slap a fresh coat of paint over a foundation that's got some serious cracks? The surface numbers always look good, but the real story, the one that's actually going to impact your money, is always buried a few layers deep. And trust me, we are going to dig until we find it. You're damn right we are. And to do that, we have a clear inspection plan laid out. First up, we're going to examine that ironclad quarter, the big, shiny numbers that have everyone so excited. Then we'll start forging ahead into the segment breakdown to see if the strength is real or if it's just one part of the business doing all the heavy lifting. After that, we'll look at the CEO's blueprint. What's the plan here? Then we'll check Wall Street's temperature. But, and this is the most important part, we'll go searching for stress fractures, looking at what the insiders in the options market are really doing. Only then can we deliver the final verdict. Is Stryker a golden opportunity or a dangerous trap? All right, let's get into it. Section 1, the ironclad quarter. You know, every analysis we do here starts with the raw material, the numbers. And I gotta tell you, on the surface, the material Stryker just gave us looks like pure, high-grade forged steel. You simply cannot argue with these top-line results. This is the load-bearing wall for the entire bull case, and right now it looks incredibly strong. In Q4, Stryker didn't just crawl over the expectation line, they took a bulldozer and smashed right through it. Here it is, the first pillar of the entire structure. $7.171 billion in revenue for one quarter. Now, that number is an 11.4% increase from this time last year. Think about that for a second. In this economic environment, with all the talk of inflation and slowdowns, a massive company like Stryker is still putting up double-digit growth. This isn't just some slow and steady incremental gain. No. This is pure, heavy lifting. It shows you there is massive demand for what they sell and that their execution is nearly flawless. This number, right here, is the cornerstone. It tells you the engine isn't just running, it's redlining. And that massive revenue engine, it's translating directly to where it counts. The bottom line, cold, hard profit. We're looking at GAAP earnings per share. That's the official by-the-book number of $2.20. Now get this, in the same quarter last year, that number was just $1.41. That is a jaw-dropping jump of over 55%. This demonstrates some serious operating leverage. What does that mean for you? It means as they sell more, their profits are growing even faster. They're becoming a more efficient, more powerful cash-generating machine with every single sale. The foundation isn't just big, it's dense, and it's incredibly profitable. Okay, so a strong foundation is great. Fantastic even, but a real fortress, one that can withstand anything, has to be supported by multiple powerful columns. If everything is resting on one single point, it's just a point of failure waiting to happen. So the next critical step is to look under the hood. We need to see where this incredible growth is actually being forged. Is it all coming from one hit product, one lucky break, or are we looking at broad-based strength across the entire company? Let's get to the segment breakdown and find out. And this table, this right here, is like the architectural blueprint that proves the whole thesis. You see strength literally everywhere you look. Orthopaedics and spine, their legacy business, their bread and butter, it's still turning out a very, very respectable 8.8% growth. That's solid. But the real story, the absolute blockbuster, is over in their MedSurg and Neurotechnology division. It's up 11.2% overall. But zoom in with me. Look at the components. Instruments, up almost 12%. Endoscopy, over 12%. And then there's the star of the show, the medical division, surging ahead at a blistering 15.6%. The takeaway here is absolutely critical. This is not a one-trick pony. This is a diversified, high-performance machine with multiple growth engines all firing at the same time. This is what real structural integrity looks like on paper. Wait a second, hold on. Broad-based strength? Let's not get carried away and start glossing over the details. I pulled this quote directly from the Q&A section of their latest earnings call. While you're over here celebrating the huge numbers, management themselves admitted to weakness. They were asked point blank about which businesses stood out, and they specifically named trauma and extremities and vascular as standing out on the, and I quote, opposite side. And look at that table again. Spine grew at 2.5%. That's barely keeping up with inflation. So yeah, MedSurg might look like a giant steel beam, but it seems like other parts of his structure are starting to look a lot more like rotting wood. This is the first hairline crack.
Okay, a minor crack, maybe. But any good builder knows you don't just focus on one little fissure, you look at the architect's overall plan. Pockets of variability are normal in any massive structure. The real question is, does management have a credible blueprint for sustained long-term construction? And when you actually listen to the CEO, Kevin Lobo, it becomes crystal clear they are not just reacting to the market. They are executing a deliberate, offensive strategy that's designed for durable, long-term growth. So let's take a look at that blueprint.
Lobo calls it their high-growth offense, and it's basically a 4-part blueprint for market domination. Step 1, it all starts with talent and culture. He calls that the absolute bedrock of the entire company. Step 2 is active M&A, mergers and acquisitions. They aren't sitting around waiting for the next big thing, they are actively hunting for it, buying up new tech to bolt onto their already massive platform. Third is a relentless, steady cadence of new product launches, making sure their sales force always has the newest and best tools on the market. And finally, specialization. They're strategically creating these super focused business units to drive deeper and deeper into their key markets. Don't be mistaken. This isn't a plan to just defend their turf. This is a blueprint to go out and conquer new territory. And listen, this isn't just some fluffy corporate mission statement. They're backing up all this talk with cold, hard numbers. Management is officially guiding for 8.0% to 9.5% organic net sales growth for the entire next year, 2026. After the massive year they just had, they're not guiding for a slowdown. They're not saying we're going to take a breather. They are guiding for another year of elite, high single-digit growth. This is management planting a flag in the ground and telling the entire investment world, you see that powerful performance? Get used to it. The blueprint is working. And this quote right here from the CEO, it sums up their entire posture perfectly. We are on offense right now looking at deals. Just think about the language he's using. This is the language of a company operating from a position of absolute power and financial strength. They're not worried about paying down debt. They're not trying to shore up their balance sheet. No, they have a war chest, and they are actively hunting for more companies to buy, to add even more firepower. Let me tell you, a company that's worried about its foundation doesn't go out shopping for more bricks. Stryker is planning on building a whole new wing for the fortress. That confidence from the CEO is impressive. I'll give you that. It really is. But a great blueprint is completely worthless if the building becomes so expensive that it's a terrible investment. The company's story sounds fantastic, but what's the price of admission? What does it cost to buy a piece of this fortress? It's time we check in with the rest of Wall Street, the people who are actually putting a price on this thing, and see what they think this structure is truly worth. Because remember, no matter how strong the company is, overpaying is the fastest way to demolish your portfolio's returns. And right here, this is where that beautiful blueprint starts to look really, really expensive. A price-to-earnings ratio of over 46, a price-to-sales ratio over 5.5. Let's be perfectly clear, these are not bargain basement prices. You are paying a premium, a top dollar price for a premium company, and that, my friends, is where the risk is forged. At these levels, the market isn't just pricing in the great quarter they just had. It's pricing in absolute, utter perfection for years to come. If they hit even a tiny pothole, if one of those weaker segments you pointed out gets just a little bit weaker, this stock could get re-rated downwards and it will happen fast. Remember, the higher you build the tower, the harder the fall. That's a fair point on valuation. It is pricey. But you're ignoring the context here. Yes, the stock is trading at a premium, but the professional analysts, the people who model this company day in and day out for a living, they overwhelmingly believe it's worth it. The consensus rating is a firm buy, with an average target price of over $426. That implies there's still significant upside even from these elevated levels. They've run the numbers, they've heard the CEO's blueprint, and their conclusion is clear. The growth story here absolutely justifies the price tag. The market is paying for quality, and it expects the structure to just keep getting taller. Wall Street analysts, come on, they're pretty much paid to be optimistic. I'm a lot more interested in what the people with real skin in the game, with their own money on the line, are doing. It's time to stop looking at the polished architectural renderings and the fancy blueprints. It's time to start running some real pressure tests on this thing. We're going to look at two key indicators that cut through the noise, what company insiders are doing with their own stock, and how the really sophisticated traders are betting in the options market. This is where you find the stress fractures before they turn into catastrophic failures. And here it is. the first major flashing red flag. On the left, you've got Wall Street screaming buy. On the right, you have the company insiders, the executives, the directors, the people who know this business better than anyone on planet Earth, and they are doing the exact opposite. In the last 3 months, they have sold over 500,000 shares of their own company's stock. So let me just ask you a very simple question. If the foremen on this big construction project are quietly selling their shares, why on earth should we, the investors, be buying in? This is a massive, massive disconnect, and it's a huge warning sign you can't ignore. And it gets worse, a lot worse. Let's look at the options market. This is where the big money, the smart money, places its bets. First, the trading volume is nearly 6 times higher than normal. That tells you somebody is expecting a big move. But the direction of those bets is what should make you nervous. Put options, which are basically bets that the stock is going to fall, are outpacing call options, bets the stock will rise, by a massive 7-to-2 ratio. For every 2 bullish bets, there are 7 bearish ones. And on top of that, the market is pricing in a potential 3.7% swing in the stock, which is almost double its historical average. This is not just some routine hedging. This is a significant directional bet from sophisticated traders that this stock is headed for a fall. So let's just put all this together. The people who actually run the company are selling their shares by the truckload. Sophisticated options traders are placing huge, outsized bets that the stock is going down at a ratio of 7-to-2. They are anticipating a move that is double the historical norm. You have to stop and ask yourself, are these traders betting on a foundation failure? They see the premium valuation, they see the pockets of weakness that management admitted to, and they are positioning themselves for a big crack in this pristine facade. This is the very definition of a stress fracture. Okay, we've laid the foundation with the blockbuster earnings report. We've examined the CEO's ambitious blueprint, but we have also pressure tested this entire structure and found some potentially serious warning signs from the people who know it best, the insiders and the options market. So now it's time to weigh all the evidence. We have a powerful bull case built on pure performance and a very compelling bear case built on the activity of the smart money. So what is the final verdict? Is this an ironclad investment opportunity, or is it a carefully disguised structural trap waiting to spring? Look, the bottom line is this. The bull case, my case, rests on the undeniable strength of the foundation you see on the left. You have 11.4% revenue growth, a massive EPS beat, strong guidance for next year proving this is not a fluke, and you have clear, undeniable dominance in their key high-growth segments. The numbers are real, they are powerful, and they point to a best-in-class company. And my case, as you see on the right, is just as clear. Over 500,000 shares sold by the executives who have all the information. An options market that is absolutely screaming caution with a 7-to-2 put-to-call ratio. A premium valuation that leaves absolutely zero room for error. And a direct admission from management about pockets of weakness in their own business. You simply cannot ignore these warnings. The beautiful exterior might be hiding something fundamentally unstable underneath. We have inspected the raw materials, we have reviewed the blueprints, we have run the stress tests. Here at Iron Financial, we don't believe in maybes. We don't shy away from making a call. After analyzing all of the data, from the earnings transcript all the way down to the undercurrents in the market, we have reached our conclusion. The iron verdict is this. Stryker has a structurally sound core, but it is surrounded by significant cautionary flags. You cannot deny the operational excellence of this company. The growth engine is real, the profitability is impressive, and the management team has a clear, effective strategy. The core business, the company itself, is an iron fortress. However, the bright red flags from the massive insider selling and the overwhelmingly bearish options activity are simply too significant to ignore. They represent a potential trap for unwary investors. The stock's valuation is high, and sophisticated money is clearly betting that the near-term future might not be as rosy as this latest earnings report would have you believe. So this leaves you, the investor, with a critical choice. Do you trust the blueprints and the proven strength of the foundation, the incredible earnings, the powerful growth, and the confident CEO? Or do you heed the very loud warnings coming from those closest to the project, the insiders and the options traders, who are signaling that there might be danger just around the corner? How you answer that question and how you weigh that pristine foundation against those visible cracks will ultimately define the durability of your own portfolio. Thanks for joining us at Iron Financial.